Problem 7.5b deals with incremental analysis, also called differential analysis. This is an important tool that managers need to have and be able to utilize. You can use such a tool in decisions having to do with canceling or continuing a particular program or product or a department. As in this case, we're wanting to determine if we should continue or if we should eliminate one or two divisions of a particular company. We focus on the additional or incremental revenue and or the additional or incremental cost, and we look at the net impact on net income. We want to have situations where the incremental revenue minus the incremental cost will result in an improvement in profit. Sometimes it will be revenue and expenses that will be involved. Sometimes it will just be revenue. Sometimes it will just be expenses. It depends on the kind of decision that is being made. In this problem, we have a company with 4 divisions. You will notice from the information that divisions 1 and 2 are profitable, $150,000 and $70,000 respectively. However, divisions 3 and 4 are demonstrating lack of profit. Division 3 has a $35,000 negative profit, and Division 4 has a larger negative profit of $56,000. Overall, the company is showing a profit of $129,000. And so the question is, are we able to eliminate one or more divisions and improve the profit of the company compared to where it is presently? We have some specific information that we need to deal with. We have cost of goods sold, and selling and administrative expenses, and you will notice the breakdown for those 2 categories. Variable cost in each division is represented by each of these percentages. Let's just focus on Division 3 and Division 4 at the moment. You will notice that Division 3, 70% of its total fixed cost is represented by variable cost, which means the remaining 30% would be fixed cost. Its selling and administrative expenses, $75,000, 60% is variable and 40% would be fixed. For Division 4, you can see the breakdown, 90% variable, which means 10% would be fixed. And for the selling and administrative expenses, 70% is variable, therefore 30% would be fixed. You should also note that the company says that discontinuation of any division would save 50% of the fixed cost and expenses for that division. Variable cost, by definition, goes if a division is eliminated. So the question is, would the fixed cost go as well? And in this case, the answer is 50% of the fixed cost for a particular division would go if that division is eliminated. Specifically, if we were to eliminate Division 4, then 50% of the $70,000 of fixed cost would be eliminated, after, of course, taking 30% of this number, because 30% is fixed, so 30% of 70,000, and then half of that would be eliminated if we were to get rid of that division. The other thing you want to note is that one or both of the divisions should be considered for discontinuation. The first thing we have to do is compute the contribution margin for divisions 3 and 4. Recall from previous discussions that contribution margin is your sales minus your variable cost. So let's do the computation of contribution margin for Division 3 and then Division 4. Based on the data we have, revenues for Division 3, $310,000, and we need our variable cost for cost of goods sold and for selling and administrative expenses. So we would take 70% of 270 and 60% of 75. And so you will notice here that for Division 3 we have $189,000, which is 70% off 270. And here we have $45,000 for selling and administrative expenses, which represents 60% of $75,000. Similarly, for Division 4, we take its revenues of $170,000, and then we would take 90% of 156, which would be the cost of goods sold that's variable, and then 70% of the selling and administrative expenses, which would give us the variable portion for that. So you can see here $140,000, which is 90% of 156, and then 70% of 70,000 is 49,000. The result is Division 3 has a positive contribution margin of $76,000, whereas Division 4 has a negative contribution margin of $19,000. And this is already instructive because it tells us that Division 4 is not able to generate enough revenues to cover its variable cost. So even if we were to stop at this point, it's likely that Division 4 would be the one that's placed on the chopping block. But let's not be too hasty. Let's continue with the analysis. And so now we're going to prepare an incremental analysis concerning Division 3, where we look at the incremental revenues, incremental expenses or cost, and see if the net impact on our net income would be an increase or a decrease. Recall that if your revenue increases and everything else stays the same, net income would increase. If your expenses were to increase and everything else stayed the same, then your net income would decrease. The opposite would be true. If revenue were to decrease, net income would decrease if everything else stayed the same. And if your expenses were to decrease, then your net income would increase. Let's look at our incremental analysis or differential analysis. The contribution margin, revenue minus variable cost for Division 3 is $76,000 as we computed earlier. And if we were to eliminate Division 3, then that contribution margin would disappear. So that would have a negative impact on net income for the corporation. Let's move down to the fixed cost. Again, remember 30% of the total cost that we have would be for the fixed cost, and 40% of the selling and administrative would be for fixed costs. And so when we take those calculations for Division 3, we end up with $81,000 for cost of goods sold. And if we eliminated Division 3, then 50% of the fixed cost would still be there. So the impact of eliminating the Division 3 would be that we would still have $40,500 off the fixed cost. Therefore, the impact on our net income would be that our net income would increase by $40,500, because that's the amount by which our total fixed cost would decrease. Similarly, $30,000 is 40% of the selling and administrative expenses for Division 3. If we were to eliminate that division, then 1/2 of the fixed cost would still be there. And so there will be a $15,000 reduction in fixed costs, which would cause the net income overall to go up by $15,000. In summary, we have a $76,000 decrease in net income, offset by a $55,500 increase in net income. So on balance, we would see a $20,500 drop in net income if we were to eliminate Division 3. So this would tell us that Division 3 may not be the division that we want to eliminate, because overall profit would decrease by $20,500. Let's look at Division 4. Division 4, remember that Division 4 had a negative contribution margin of $19,000. So if we got rid of that contribution margin, would then be indicated here as a $19,000 increase in the net income of the organization. We have $15,600 of their fixed cost that goes to cost of goods sold. One half of that would still be there if we were to eliminate, and so there would be an improvement in the net income of the corporation by $7,800. 40%, I think that's the percentage we're dealing with, actually 30% of $70,000, which would be $21,000, is the fixed cost. We would then still have half of that if we eliminated Division 4, and so there will be a $10,500 increase in net income should we eliminate Division 4. Overall, we're looking at a $37,700 improvement in profit if we were to eliminate Division 4. Again, note this carefully. This is saying that if we eliminated Division 4, the profit of the organization would improve by $37,700. So comparing that with what happened with Division 3, we would definitely want to eliminate Division 4 and have our profit increase by $37,700. And so the recommendation would be, again, based just on the quantitative aspect of things, would be that we continue with Division 3, given the contribution margin of $76,000, and we would eliminate Division 4 because it would result in an improvement in the overall profit of the organization. So now let's show what we have stated earlier by preparing an income statement, and it says we should use a CBC income statement, meaning that we should first subtract variable cost from our sales to get contribution margin, and then subtract our fixed cost. And so just as we did earlier, we take the sales for the remaining three divisions, 510 for Division 1, 400 for Division 2, and 310 for Division 3. These numbers are derived from the original data that we have. Remember, Division 4 is now gone, and so this $170,000 of revenues would no longer exist, and the variable cost that accompany that would also disappear. We then take the respective cost of goods sold for each division, 210, 200, 189, and this column on the right where we have the totals would represent the sum of each division. So if you add the 510, the 400, and the 310, that's giving you 1,220,000, and the same thing is true for the expenses. So we subtract the variable cost and we get our contribution margin. Again, adding across, we have a total of $512,000. We then subtract the fixed cost for cost of goods sold and the fixed cost for selling and administrative expenses. And down here I show you how we arrived at those numbers. Recall, for example, that Division 4 had cost of goods sold of $156,000. Half of that is going to be, well, not half of that, but 10% of that represents fixed cost, and then half of it is going to still be there even though we have eliminated the division. So we take 10% of 156, and then 50% of that gives us $7,800. We're going to share that or spread that among the 3 divisions, and so each division will get 1/3 of 7,800, which is 2,600. So included in this total here for cost of goods sold fixed would be 2,600. Same thing is true here, and the same thing is true here for Division 3. Similarly, for the fixed selling and administrative expenses, we are eliminating the fixed portion for Division 4. Remember that 30% of this, which is 30% of 70,000, is 21,000. And so half of that would still exist even after the division has been eliminated. And so we have a total of 10,500 that we're going to share among the 3 divisions. And therefore, each division will have 3,500 of the total 10,500 that will be added to their fixed selling and administrative expenses. So this includes an additional 3,500, so does this, as well as the 33,500. So now we have net income for Division 3 is now 143.9. Net income for Division 2 is 63.9. Net income for Division 3 is still a loss of 41,100, but notice that overall we are in a better position. Before, we had a total profit of 129, and now we're looking at a total profit of 166,700. Why did we have that improvement? Because given our incremental analysis, we indicated that if we were to eliminate Division 4, there would be a $37,700 increase in net income. And so 37,700 plus the original profit of 129,000 gives us our new profit of 166,700. And this is what I stated here. Original operating income or earnings before taxes of 129,000 plus the incremental income of 37,700 that would result from eliminating Division 4 gives us our new overall profit before taxes of 166,700. Again, incremental analysis at this level, at the quantitative level, doesn't factor in the qualitative factors: impact on employees, impact on society. But strictly based on the numbers, Division 4 would be the one on the chopping block, and as a result we would have an improvement in the overall profitability or profit of the company.